Good morning, everybody. Hope the week is treating you extremely well. In today's video, we're going to be taking a look at something we haven't talked about in a while, and that would be the volatility index, or the VIX. We have some interesting data that just came out that we're going to be taking a look at in the beginning of this video. Then we're going to take a look at the technical setup on the S&P 500, the area of resistance that we are currently facing. We'll also take a look at the emerging markets at the end of the video and wrap everything up. So let's jump right into it. The VIX is a measure of expected price fluctuations in the S&P 500 futures over the next 30 days. People use it as that fear index. As the VIX is spiking, the market essentially is pricing in larger and larger potential moves in the short term, and that is what is viewed as that fear component. Now, when the market is under its 200-day moving average, typically the VIX is elevated. The long-term VIX average is 20. And right now we're at about 15. So we're well below that long-term average. And when the S&P 500 is under its 200-day moving average and the VIX is under 20, it actually puts up some very precarious numbers for the market moving forward. Let's take a look at that table. Now what we have here is from 1990 all the way to today, when we take a look at the S&P 500 being under its 200-day moving average, the VIX hitting 3-month lows, and the VIX being below its long-term average of 20, what we get is a number of instances, and for the most part, this is extremely negative historically for the market. We go back into the 90s. You can see we have a little bit of a one right here. The market makes a downturn. The mid-90s, that was actually where over the next couple of weeks, maybe the market was down, but over the next month and year, the market was up. The rest of the clusters all happened during the dot-com pullback and during the 2008-2009 financial crisis. And when we take a look at the average risk to reward over the next year, the numbers are extremely skewed in the bear's favor. Over the next week, the market's positive only 28% of the time. Over the next 2 weeks, only a third of the time. When we go out over the next 6 months, the market's only positive 11% of the time. And 1 year later, the market's only positive 40% of the time. And our average risk to reward is massively skewed in the bear's favor. Over the next 6 months, our average down draw is 21%, and our average upside is 1.9%. This is one of the most bearish looking reports that we have seen. And if we think through the logic of what this is actually telling us, is when the S&P 500 is under the 200-day moving average, that is typically a bearish component. And the VIX hitting a 3-month low while the market is still under the 200-day moving average says that the market has gotten complacent. And people have gone from being concerned about lower prices to not being concerned about lower prices. And as we know, the crowd is wrong at the turning points. So sentiment, if we think about where sentiment readings are right now, they have actually gone from where we were in December of extreme fear to now we're actually to greed levels in the sentiment ratings of the market. So we've gone that far, that quick, from fear to now greed. We typically know what happens after we get into that greedy zone. We typically tend to fall back down. And so that is what has happened in the past. Again, the market being under that 200-day moving average, VIX hitting a 3-month low, and it's below its long-term average of 20 is showing complacency in the market and a technical zone where we probably shouldn't have a lot of complacency because there's still a ton of risk. We take a look at the S&P 500 here, right? Purple line being that 200-day moving average. We have had a heck of a rock and roll higher here over the last month. I mean, we're up off of the bottom almost 20%. I think we're up 17% or so. Right, and we went from extremely oversold to now we're right back near that 70 level on RSI, so almost to that overbought. We're right at that 200-day moving average, but we're testing it from the underside. And when we think about technical analysis, zones of support, when we break through them, become resistance. All right? And when we break through a zone of resistance, it becomes a zone of support. So we broke through this level of support. It should now act as resistance. All right? If it doesn't, then now we've got the opportunity for the market to continue to push back up. So as we have talked about in these videos, the important level for me is that 200-day moving average all the way up to the previous technically important zones, these previous highs. Because what a downtrend is a set of lower highs and lower lows. And right now we have a high, a lower high, and this could potentially still be a lower high. It has to take this one out in order to negate that downtrend. And on the lows, we have a low, we have a lower low, and we have a lower low. So the trend is certainly down over the last few months. And so if the market can take this zone out, and that would negate that downtrend. But we have used a lot of ammunition. The bulls have used a lot of ammunition making this incredible bounce back, this beautiful V-shaped rally right into resistance. Okay, right into that major resistance zone. There is a lot of battle that should take place in this zone. And if we take a look at the way sentiment is laid out, we take a look at how much velocity and how much buying pressure has been used up essentially to put us right back into this resistance zone. The fact that the market is nearing that 70 RSI, that overbought rating, makes me very cautious right here. All right, this was one heck of a run up. All right, typically you are going to see a pullback, right? Even if we ultimately do break through this zone up here, we typically are going to see a pullback. The market moves in waves. So we had the wave up, we should get a pullback. Now, whether we go all the way back down or not really becomes the major question, but we could easily get a 50% retracement and then turn around and ultimately make that breakout. But to go straight from all the way down here, straight all the way through this major zone of resistance would be an incredible move. Certainly something that could happen when we take a look at the data, when we take a look at the way the sentiment currently is, when we take a look at the overbought ratings, when we take a look at that major price resistance zone right here. It certainly leads us to need to be extremely cautious. Now, one thing that we have been talking about a lot is the emerging markets. Right? I don't think we can have a major collapse on the U.S. indexes with the emerging markets continue to stay buoyed up. I don't think that can happen. What we're looking at right here is the emerging market index has broken its long-term downtrend. It put in a set of higher lows on this bottoming pattern, has broken out over that key zone from early in December, is trading over the 200-day moving average, is now over the 200, the 10, the 20, and the 50 moving average. So it's over all the moving averages. All right, this has acted extremely well. I think a major key to what's going to happen this year is whether the emerging markets can continue to push higher or not. They led us to the downside last year. Right about here, they continue to keep making new lows, where if we pull back the S&P 500, the S&P 500 said nope and continued to push higher. So we had that collapse inside the emerging markets, that lead lower, and then later in the year, our markets played catch up with the emerging markets, and that's where we got that sharp sell-off at the end of the year. Now, the emerging markets have been leading to the upside on a technical basis. This year, they put in a higher low. So again, we go back into December on the S&P 500. We put in a much lower low. All right, the previous low was all the way up here. We went all the way down there. When we take a look at the emerging markets, it put in a higher low. It did not take out the October lows, and that was a very clear sign to me that we probably had a good bounce opportunity in play. So what I am paying attention to is I'm continuing to pay attention to sentiment here in this market, continuing to pay attention to the major technical levels on the S&P 500 and all the major U.S. indexes, but I'm really paying close attention to the emerging markets to see how the rest of the globe is doing right here. If it can continue to hold up and continue to grind higher, I think that should abate the fears that we have here inside of the U.S. However, if the emerging markets do start to make that rollover, I would be very concerned with everything globally here. So, as always, we're going to continue to monitor these things. We'll discuss them. We'll take a look at these charts on a weekly basis. I hope you guys have yourself a fantastic weekend, and I will see you guys next week. Thank you so much.